Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. So, welcome back to the Moneymakers Investment Trust podcast. This week I am joined, as every month, by Andrew McHattie, the editor of the Investment Trust newsletter, to review some of the most recent news items. You can, of course, get access to all the latest news from the investment trust sector if you are a subscriber to the Moneymakers newsletter, where we do a weekly email along with our trust profile, which this week features Finsbury Growth and Income Trust, managed by Nick Train, plus some comments about some other recent developments that we may not cover today. So, Andrew, here we are. We are into month 3 of the new Trump administration, and it continues to send waves around the world. I don't think we can deny that. The US stock market has taken umbrage, I think, at some of the policy decisions that Mr. Trump has made, and the fact that there's very little certainty about what is going to happen with tariffs or indeed with Ukraine or any of the other initiatives that he and his colleagues are pursuing. So the S&P 500 is down around 10%. Technically, I think, qualifies as a correction, while other markets are doing slightly better. And bond yields in the US continue to edge a little bit higher. So that's not an encouraging backcloth, particularly for any investor that invests in equities, and many investment trusts do that. So, Andrew, just give me your thoughts on where we are. We've had a correction. Is that going to continue, do you think, or is it something that was just necessary from overvaluation and hype and so on?
Well, President Trump certainly lent a lot of colour to our days and to our news flow, doesn't he? And I think you're right. So much of what's happened in the American market has been driven by what's coming out of the White House, which is extraordinary on a day-to-day basis. And I think perhaps the market would have been able to have happily assimilated some of that news on tariffs and on some of his new policies. But I think the market was quite spooked when he failed to rule out the possibility of a recession. And he said that the American economy was having to go through this period of transformation. And I think that did upset actually quite a few investors who are concerned about much higher inflation, slower short-term growth, perhaps slipping into recession, and definitely, I think, as well as slower pace of interest rate reductions for the moment. And I think that on the one hand, we do have all of this news coming out of the White House, which is clearly extraordinary and completely beyond anything we normally see. But on the other hand, I think if you're a seasoned stock market investor, you're probably not that surprised that there's been a correction in the US market, because these do happen periodically. A 10% reduction in the market, a correction, is actually a very common occurrence. It happens every 18 months or so. And actually, of course, the US market was on a previously elevated rating. And so I think against that background and a good period previously for American markets, maybe this is actually quite an ordinary development after all.
Yes, you're right, I think. And the other factor, of course, is that many people took the view, based on what Trump used to say during his first term, that there was a so-called Trump put, that if the stock market went down a lot, he would take note of that and he might change his mind, on the basis that he always thought that a strong stock market was both a vindication of what he was doing and a sensible judgment on how he was doing. But as you say, he's talking about there will be some disruption and so on. It does seem that it's not so important against his bigger agenda, which is to do what he wants to do, which may or may not be sensible, shall we say. And notable also, I guess, that gold has gone past $3,000 an ounce this week, which is a reflection, I think, both of the uncertainty that Trump is creating, but also the continued geopolitical uncertainties. We don't know where the Ukraine war is going, or whether indeed there will be a ceasefire and or eventually some kind of peace deal. So against that background, the investment trust sector is obviously going to be struggling a little, because we know a lot of the large equity trusts that remain in the sector have big weightings in the US market inevitably, so they're going to be affected. If we take a look at some of the performances over the last 5 days, I mean, it's basically been very diverse, the kind of performance of individual trusts, as you would expect. But with all this volatility going on, there have been some notable winners and some notable losers. Has anything in your portfolio been pleasantly surprising, or has it been more a case of having some disappointments to deal with?
I've been conscious of this dichotomy for a while, actually. I think we did reach something of an inflection point at the start of the year when European stocks, which have been very quiet for ages, had a really good bump. And maybe this big shift in international relations is very good news, actually, for European equities. And the increase in defence spending, I think, has given them a very considerable boost. If we want to be pejorative about it, this is all part of Trump's mega policy, making Europe great again. And I think we have seen, actually, this differential performance, which is not a surprise. And of course, because the US takes up about 70% or so of global indices, that means most of the general global funds have gone down. But when I was choosing one recently for my annual ISA recommendations, I was looking very much for those that had lower exposure to the US. So something like ABI Global Trust, for example, has a far, far lower exposure because it's a value-oriented trust. So inevitably, it's the growth-oriented trusts that are more exposed to the US that have been going down. And I think it does pose an interesting question for investors who have done very, very well from especially the tech-exposed trusts, which are of course, very exposed to the US principally, because they performed very, very well last year and the year before, which means if you hold these in your portfolio, they've probably grown now to an outsized position. And maybe you're slightly concerned now and thinking about taking profits. So I think that's the really interesting question. Should you come out of the US a little bit now and switch into other markets, or are you too late because the correction's happened? And I think that's the really interesting question.
Yes, I think that's right. And you can find authoritative voices arguing both cases, I think. I mean, certainly for a long time, people have been saying that the US was overvalued and was due a correction, and the big tech story would not continue. But it is fascinating looking down the list of performers. Every week we get a number of trusts going up by more than 5% and others going down by 5%. It really has been quite a volatile ride. I've been looking at the year-to-date numbers. It's very interesting, and just in terms of NAV performance, this is, before we look at discounts. And so we've got 187 on the list I'm looking at, which have got negative NAVs this year. And against that, we have something like 113, which have made positive returns. But more importantly than that, the range is pretty wide. Those that have gained, a lot of them are up 5, 6, 7, or even double-digit returns. And those, on the other hand, are going down. So there's a lot going on. And I guess one of the lessons we have to think about is, how to react to that kind of volatility. Do you actually take it as a signal you need to do something, or is it just something which is an extreme example of the kind of volatility we get most of the time?
My sense here is that you should carry on investing in the same way you've always invested. And so if you are a long-term investor with a relatively passive approach, then I think that's fine. And actually, you can continue to hold these investment trusts, which are of good quality, and you don't need to worry too much about these short-term movements. If you're a more active investor, you can take advantage of it. You can embrace the volatility and you can buy on the dips. And I think actually that's a very valid approach. I've always really liked the concept of monthly saving, actually, that you continue to put money into the market regularly if you have an income that allows you to do that. And if you do that, you can almost be price blind. So you can just keep on doing it. And that inevitably means that you buy more shares when prices are low. And that has to be a great thing. So you can even it out. It all depends on your own approach. But I do think you shouldn't abandon common sense. You shouldn't be driven too much by the news flow. So stick to your knitting, stick to what you normally do.
And specifically with regard to investment trusts, I mean, it is very easy to become fixated on discounts. We all talk about them a lot because they are such an important feature of the investment trust world. But just because discounts are moving around doesn't mean that you should necessarily spend your time trying to move in and out of those trusts where the discounts are apparent. That's something which the specialists and fund managers are meant to do, and some of them do it successfully, others don't. But there's a lot to be said for just, as you say, sticking to your knitting and allowing the discounts to take care of themselves. It always sounds rather unprofessional to say that when you can see that there are these big discounts, but actually it's quite a proven way of doing quite well, I think, over time. That would be my position anyway. Let's talk about then some of the stuff that has been in the news. Maybe we should start with what's going on in the commercial property sector, which is very interesting, I think, at the moment. We know that there have been quite a lot of corporate activity in the commercial property sector of the investment trust world, but we've now got a sort of second phase where we're seeing a number of commercial property trusts opting to exit the investment trust sector, at least formally exit the investment trust sector in a number of ways. And perhaps we could just talk about that and what some of these trusts are doing. For example, could we take supermarket income as a good example of what's happening? This is a trust that invests, as its name suggests, in supermarkets. What have they said they're going to do, and how does that fit into the general pattern?
The property sector does seem to be very much at the forefront of the news at the moment. And rather like rats leaving a sinking ship, I think this is the REITs leaving a sinking ship. And actually, there are numerous exits occurring at the moment in, I think, three distinct ways. And one of those ways is very much encapsulated by Supermarket REIT. So Supermarket REIT is intending to internalise its management. At the moment, there is an external management contract with Atrato, and the trust is saying that actually it wants to effectively buy out that management contract and then employ the managers directly as part of a commercial company arrangement. And by internalising the management, it's effectively going to leave the investment company sector. We've seen this before. We've seen other companies do this, not just in the property sector, but elsewhere as well. And it means effectively they're saying, well, we're not getting a good enough rating in the investment company sector. We can't raise capital in the investment company sector, so we're better off as a listed REIT under a commercial property environment where hopefully we can attract different investors. We can raise money because we don't have to be so focused on that discount to NAV. And we're effectively reorganising ourselves to try to give ourselves a better chance of future success. And it's a huge shame that that's happening outside of our beloved investment company wrapper. But I think that's the reality. And Supermarket Income REIT is not alone in doing this.
Indeed, it's not. And that, as you say, has become more of a trend recently. We've had some other examples. If we look at urban logistics, for example, that's another one which is doing something similar-ish. What do you make of that one?
It's very much the same. Again, the trust has said that it's going to effectively buy out the management contract. It's quite costly, by the way. I mean, I did think when I read it, well, why don't they just terminate the contract and then offer these people jobs? Maybe that's a bit cheaper, but I guess that's just not feasible. So they're buying out the management contract. This is the proposal, and it will then save them money on an annual basis. So they get a payback over time. So again, it's the same idea that they're just really fed up with being in the investment company sector and being underrated in their own view. And this is an interesting point that perhaps they've been undervalued by the market because they have attracted a shareholding by Achilles Investment Company, the new vulture fund, which we've been talking about. And that's announced a 3.2% stake here, which certainly enlivened, I think, the market view of it. Now, Urban Logistics has come out with a statement saying that it has not received any kind of takeover or reorganisation proposal at this point. But clearly, I think many investors will think that's possibly on the cards. So we've seen a little bit of a re-rating here, but still the discount is around, I think, 18 to 19% this morning. So there's still a bit of value to be had.
Right. I mean, dare I mention in this context, how much is cost disclosure an issue here? Because if you remember going back to when we had all that argument about cost disclosure last year, it was commonly said that if you compare the performance of something like Segro, which is not an investment trust but does basically the same thing, they did have a better rating. And I guess, as you're saying, by moving back into the REIT market, the ordinary REIT market, you're hoping for a better rating. Is cost disclosure a factor there, do you think, or is it just other logic as well?
Well, no, I think it is very much a factor. And I think we've got some data to back this up now, because if you look at the ownership structure of these kind of investment companies, they are much less owned by retail investors. Retail investors tend to prefer equity investment trusts. We can see that from AIC figures that have been released. And wealth managers and institutions tend to own these alternative asset trusts much more. And it is really the wealth managers that have been selling down investment trusts across the range, but including REITs. And I do think wealth managers are much, much more influenced by cost disclosure than other groups, because they have to tell their clients about the costs and it bothers them. And so that is undoubtedly an issue, and it's an ongoing problem that has yet to be resolved. And I suppose to some degree, if you're running an investment company that is affected by this and you're on a low rating, you can be patient to some degree, can't you? And you can look at the news flow and think, well, this is going to be sorted out, so that's great. We'll just sit tight and keep with this structure, and eventually the cost disclosure problem will go away. But of course, as it rumbles on and doesn't reach a satisfactory conclusion, so eventually you feel the need to take action. And maybe that's what's happened here, that actually these boards have reached the end of their tether and they're giving up.
Yes, well, there are other solutions. You hinted at this. This is not the only route that commercial property trusts can take. One obvious other alternative is to sell yourself to somebody else. And we've seen an example of that, again, in the case of Care REIT, which formerly was known as Impact Healthcare. A slightly different model, obviously. Just talk us through some of the other kinds of activity that's been going on in the investment trust commercial property sector.
I'm rather sad that Care REIT's seemingly going, because that was one of my recommendations, actually. Another one's disappeared. A reasonable outcome here, but perhaps it's not over yet. So there has been an offer for Care REIT at 108 pence per share, which on the surface looks very good because it was a considerable uplift to where the shares were trading on a very wide discount. So a 32.8% uplift to the prior share price, which looks really good. But actually, it's still a 9% discount to the latest asset value. And so you're not getting quite a full value here. The offer is from a US buyer called Care Trust REIT. And so I think the market is actually indicating, by having a share price now just slightly above that offer price, the market is indicating that it might perhaps expect an enhanced offer to come, or maybe a competing offer. So this one's not over yet. And we have seen actually Assura in the same sector attract more than one bid. And finally, now it has attracted one at the NAV, having previously come in lower. So there's potential for a bidding war here, and that's interesting because we have seen also Warehouse REIT. We've seen that reject some bids that have come in. It's rejected a bid at 108.9 pence, again from US buyers, and that's at a discount to the NAV of 127.5. So we're seeing bids coming in, not necessarily quite at the right level to clinch it, but that's certainly one exit route. We're also seeing more REITs still announcing strategic reviews. We've seen that from Life Science REIT. So there's an awful lot going on at the moment, but still quite a lot to be resolved.
So you mentioned Life Science REIT, which is ticker Labs, which again is a relatively recent newcomer to the investment trust sector. And again, as with many other recent IPOs or not too distant IPOs, has been very disappointing, right? I mean, I think it's trading at 38p or 39p at the moment. And it's been basically on a downhill path almost from the off. So their strategic review, the share price has perked up a little. So if you are holding it, you might make a little bit more than you might have had last week. But you're still underwater, aren't you? And that's not a very good story at all. A shame in a way, because you'd think that life sciences would be, I mean, I guess there's some echoes of Woodford here, but life sciences is a kind of growth area where you would like to attract patient capital, which our investment trusts are meant to provide. So I guess if the outcome of the strategic review is that one disappears as well, that will be another blow, I guess.
Conceptually, that always seemed like a great idea, actually, which was buying up unwanted office space, converting it into laboratories in this fantastic golden triangle of intellectual activity between Oxford, Cambridge and London. But it hasn't really worked out for Life Science REIT, because actually the demand softened just as interest rates were rising. And so that's been a bit of a disaster from the off, and shareholders have lost money. So my suspicion is that that one probably will wind up in some way, or it'll sell its portfolio. So that's another one disappearing. And I do wonder just what we're going to be left with here, because the investment company structure is clearly not working very well for REITs at this point. And I think the more of these we see, the more pressure then is heaped on the boards of the trusts remaining, because they're still on discounts and their shareholders are going to be wondering what's going on, why their boards haven't done anything. And so at the moment, depending on how you define the sector exactly, we've probably got 10 to 15 trusts left here. But I think they could all go. It could be wiped out completely. And actually, it may be that this period of having property companies operating in our sector is at an end. And they're really commercial companies, and maybe that's how they're going to end up.
Yes, I think that is a genuine concern, and that will be a loss to the sector. But as you mentioned earlier, it's a bit of a damning judgment on how investment trusts have performed and behaved over the last 2-3 years in particular. So there's still some. I mean, we've got PRS REIT, but that looks likely to disappear, I suspect, because they're doing a strategic review and looking to sell some assets, or maybe the whole company. We've still got Tritax Big Box, we've got AEW UK, and Custodian, among others, and a Regional REIT, if we dare mention that one. That's not done particularly well, disastrously, you can say. So, yes, it's a big challenge for the investment trust sector. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Moving on then, let's get back into the equity investment trust sector, where we know that discounts have stabilised, at least. We haven't seen the extreme discounts that you get in the alternative sector. We've had quite a lot of interesting results out. Let's start with one you've mentioned by inference already, which is Allianz Technology Trust, one of the two big technology trusts that have performed so strongly over the most recent period. What did you read into their final figures?
I always like to read these because it's a fascinating area, actually. And both Allianz Technology and Polar Capital Technology have been tremendous trusts to own. I think many private investors will have had those, thank goodness. And of course, last year was a very, very strong year for US technology and a very strong year for this trust. The NAV total return for the calendar year 2024 was 36.5%. And I think it's quite impressive here that actually the trust managed to keep pace with the index, because it's not easy to do that when the index is being driven by these huge mega caps. And it's the nature of an investment trust that it has a more diversified portfolio. And so it's not easy to keep pace, but this trust has, due to some good stock picking. And I'm always interested, because of course the figures we see are effectively backward looking. I'm always interested in the outlook statements and what the manager has to say about the prospects and what he's seeing in the market. And I think here Mike Seidenberg is probably slightly more prosaic in his commentary than Ben Rogoff of Polar Capital. Most people are, actually, but he's nevertheless had some interesting things to say. And I think one key point here is that the US tech market is not just about AI. Of course, we're constantly hearing about that, in particular with the prominence of NVIDIA, but actually there's a lot more going on. And many strands here that are positive drivers for the sector, including cyber security, cloud computing, the Internet of Things, and 5G. So there's a great deal going on. And interestingly, he did say in his statement that one company they've done very well from is called Palantir Technologies, which is a data analytics company. And I think that demonstrates 2 points. A, it's not just about AI in this market. And secondly, that's a company I hadn't heard of. So that's wonderful. That's why we're paying these managers to manage these trusts for us. It's not all about those big mega caps that maybe you can buy yourself. So this was all quite promising, actually. And I think it's a very good trust. It's such an interesting question as to whether you buy it or sell it at this point. It's on about a 10% discount, which is quite normal. So there's no particular input from that. I think it's really to do with your view on the markets. My sense is that if you're a long-term investor, you just keep buying these things and hold them, and you'll probably do very well in the long term. Of course, there's going to be quite a lot of bumpy performance in the near term. So that's up to you.
Yes, because you would have had people a year ago saying exactly the same thing, that you can't expect you to do so well again, and then you've been pleasantly surprised. It can't go on forever, of course, but there's no doubt the underlying trends that, as you say, Ben Rogoff is a very enthusiastic advocate of, is doing well. I mean, they both trade relatively similarly, don't they? I mean, they're both on about 10-11% discounts. They tend to move in conjunction most of the time. And, well, this year they're down around 12-13%, I think, since the market correction, which is not a lot more than the US market itself, but a little bit more. So definitely ones to watch. They're certainly not the worst performers of the year. Talking in that context, though, I guess the same kind of issues move across to Scottish Mortgage and, to a lesser extent, some of the JP Morgan trusts, which have exposure there. Very popular JP Morgan Global Growth and Income. That has quite a high weighting and so on. Basically, essentially, anything that's got exposure to anything which is globally linked to a global benchmark is going to have suffered in the sell-off we've seen. That would be right, wouldn't it?
Well, it is. You can't avoid that because so much of global indices now is the US and so much of that is these big tech companies. So, yes, if you have a broadly diversified global portfolio, unless it's a very, very concentrated portfolio that's completely different from the index, and that's quite unusual, then, of course, you're going to be down this year and you're going to be suffering to some degree from this US sell-off.
And some of those bigger trusts do look a little bit oversold on a short-term basis. Okay, so let's move on and talk about another global equity trust, and that is Murray International. It used to be managed by Bruce Stout. He's retired. And this is, again, a staple of many portfolios. It's a global equity income trust, and more or less everything in what it does is driven by the desire to maintain its dividend and grow it over time. What do you make of this one? I think this is coming up to a potentially important landmark year.
So Bruce handed over the portfolio to Martin Conaghan and Samantha Fitzpatrick, who have been co-managers for quite some time, actually. So continuity is the name of the game here. And they are continuing to manage this trust very much in a value style. And that's really the key. That this is not a growth investor, it's a value investor. And that means that the trust tends to lag in up markets and tends to do a bit better in difficult markets, actually, where it can protect some value. And so it's no great surprise that its final results for 2024 didn't make for particularly happy reading. Its NAV total return was 8.1%, which is actually quite well behind the FT All World Index, up 19.8%. So when you see a lag like that, you think, my goodness, this trust isn't doing very well. But that's really a natural consequence of its style. It is underweight in the US, it's underweight growth companies. It's got Taiwan Semiconductor and Broadcom, but it's really investing in income producing companies. And that means it has very little in tech. And it's very keen to protect that traditional structure where its income is generated by the dividends from the companies that it holds. So it's not doing anything unusual. It's not using derivatives. It's not paying any dividends out of capital. It's very traditional, but that's worked over time. And actually, if you're, again, a long-term investor and you're looking at this trust over maybe a 10-year period, then it looks perfectly okay. So I think you have to be careful about the lens you're using here. It did increase its dividend again, up to 11.8 pence per share. And that means that it has now increased its dividend for 20 years. So it crosses into the magical AIC Dividend Heroes category, which the trust is delighted with as a marketing angle. And my goodness, of course, our industry needs all of the marketing angles it can get at this time. But I have mixed feelings about this Dividend Heroes list. I admire it as a way of promoting the industry. And it's a great testament to the longevity and resilience of our sector and the fact that these dividends have increased every year for so long. But it's definitely not a buy list. These trusts, they're not all the best trusts. They're not all the ones that have increased their dividends by much. These dividend increases haven't necessarily matched inflation. And sometimes I think boards are so compelled to keep that dividend record going, maybe they're not really maximising the returns. So I'm a slight sceptic on that front.
I couldn't agree with you more. Certainly if it gets to the point where the decision to keep on increasing the dividend is compromising what might be at the expense of higher total return, there is certainly an argument to be made there, I think. But it's fair to point out that Murray International is offering a yield around 4.5%, I think, at the moment, and it is trading on a discount of 8%, and it's been on a discount now for a while, which is very much against its historical experience. So if you actually think that value as a style is coming back, given all the volatility and the hit on growth that we've seen, then that looks quite an interesting opportunity for a bedrock holding in a long-term portfolio. Okay, let's just quickly look at another trust. This one is a different mandate completely, but rather unique, and that is Law Debenture, which also has produced some final results. And again, this is a very interesting vehicle that combines a business services business with an equity portfolio managed by Janus Henderson. So what did you make of their figures, and do you like this one, Andrew?
Well, it's a unique trust, this one, and I've been following it for many years, so I have plenty to say, actually. It's a popular UK equity income trust. It's managed by James Henderson and Laura Fall at Janus Henderson, and I must say I've recommended it several times over the years. It's been a good, solid UK holding, in my view. Again, rather like Murray International, it has a value style, so that does mean that it can struggle during really fast-paced growth markets. But actually, it's a good trust. It's got a 3.8% yield. If you look at the 5-year performance tables in the UK equity income sector, this is the top performer. It's fairly average over the last year, but I think it's generally been very good. And its final results for 2024 were perfectly decent again. Its NAV total return was 13.6%, which is well ahead of the FTSE All Share, up 9.5%. Its dividend was up 4.7%, and this was its 46th year of dividend increases, so very much a dividend hero, this one. Where it really differs and where it has its completely unique aspect is that it does have this separate independent professional services business, which is wrapped into this investment company. And I think over the years, that's worked very well for Law Debenture. I'm quite surprised that it's really the only one that has barely been used this by any other investment trust at all. So it's a separate business, and it generates profits that go towards the income element of the trust. And that just gives the equity managers a bit more flexibility, because they don't have to invest in very high income producing companies right across their portfolio to generate the revenue for the dividend. So it's worked very well for the trust, and I do like it. You're paying up for that. I mean, I must say that the shares are premium rated at the moment. I think they're on a small premium of about 1%, which is unusual. And maybe that just reflects their quality. You know, over the last 10 years, this trust has produced an NAV total return of 145% against 80% for the FTSE All Share. So it's got a proven track record, and that's what you're paying for.
Indeed. So the effect of having that steady stream, as long as the business is performing well, and they are in one or two growth areas, it has to be said, which are dull but steadily growing, trustee businesses and so on. And the reward you get as an income investor is you get the yield, but you also get much reduced volatility, if that's a concern to you, because of that reason. But it is trading, as you say, around par, so it's not obviously cheap at this point. So we've covered some staples of the investment trust sector. Let's move on and talk about a sector that I know you have an interest in, which is battery storage. The news here is, well, it's been slowly getting better, I suppose, but everyone's been waiting to hear how Harmoney Energy Investment Trust gets on. What's the latest on that? Because that perhaps will give us a clue as to how attractive the assets and the outlook for the battery storage trusts are after a very, very tricky couple of years.
I've spoken about this a couple of times before, and I'm going to have to speak about it again, Jonathan, because we're still waiting actually for the outcome here. So Harmoney Energy, which put itself up for sale last year, is one of the 3 battery storage trusts listed in London. And it has identified a preferred bidder. It's been negotiating with them. It's already pushed back the date by which we were expecting an announcement. And the exclusivity period for this arrangement with the preferred bidder has just expired last week, but they're still negotiating, and they've told us they're still negotiating. So it does sound very much to me as if a deal has been struck or is in the process of being struck here. We just don't know what the price is going to be. And there's still quite a big gap, actually, between the shares and the asset value. I think it's still close to 30%. And that does mean, actually, that this is very important and it's being keenly watched, because we don't know what the exit price might be. But we also don't know whether that might have a significant read across for the other 2 battery storage trusts, which are on even wider discounts of more than 50%. So if there is demand for Harmoney's assets and they come out at a good price, we should see, I think, those other battery storage trusts bounce a little bit. But if, however, this deal breaks down and there's no good outcome, or indeed the price is not good and the portfolio is sold at a big discount to the net asset value, then that's not going to be such good news. So we just don't know at this point. It's a speculative position. I've got some Harmoney shares I've added to them, actually, and I'm sitting tight waiting for the big announcement.
Okay, so that's one to watch. And the other 2 battery storage trusts you've mentioned have been basically flat this year, so it will be interesting to see if there is any clues as to potential upside there. The other two trusts are also a little bit bigger than Harmoney Energy. So one other interesting result out this week came from Seraphim Space, their investment trust, which pretty much does what it says on the tin. It invests in companies that are involved in the space business in one form or another. So what do they have to say, Andrew, and what's your thinking on this one?
Well, it was the interim results to the 31st of December from Seraphim Space, and they were really interesting, actually. The NAV was up by 7.5% over the quarter to 101 pence a share. And the accompanying commentary was really interesting, and I think it probably is a useful reminder that it's worth digging under the skin of these investment trusts to see what they're really doing. Because if you think of a space investment trust, you're inevitably just thinking of growth capital, something quite esoteric, something that maybe doesn't relate to the daily news flow. But actually, it was really interesting to hear from the manager, Mark Boggett, about exactly what these underlying portfolio companies are doing. He explained that actually 78% of the trust holdings derive their primary revenue from defence spending. And of course, we've seen a huge boost to European defence spending because of this big shift in international relations and President Trump saying that the US is not going to fund it any longer. So this, I think, opens the prospects of significant extra returns from these companies. So, for example, the trust's largest holding is called ICI. And that's a profitable company already. And its business is satellite imagery, very high quality satellite imagery, which is important not just for commercial use in shipping, for example, but also very much for security and for military purposes. And a lot of these space holdings involving satellites are dual use. So they have a commercial angle to them, but they're also very important for the military. And so this is such an interesting point that maybe Seraphim Space is actually a defence stock in hiding. And whilst the majority of European defence shares have been on an absolute tear over the last few weeks because of this massive boost to spending, maybe another 800 billion euro to be spent. Actually, we haven't really seen that until this week anyway in Seraphim Space, which has been on a massive discount to assets generally out of favour. But it does have these big tailwinds of defence spending and also the climate issue, where, again, satellite imagery is very important. So we've seen the shares rally a fair bit this week. They're still on a discount of about 40%. But I think this is a really interesting, unique offering, and it does have this defence angle that maybe we hadn't fully appreciated beforehand.
Yeah, well, you're absolutely right. And I had a very interesting talk by the founder of Seraphim Space not so long ago. And yeah, it is an interesting company. And perhaps, as you say, have been overly tarnished by being associated with other growth capital trusts which have been struggling and treated as early stage and so on, and therefore not mature and trading at a big discount. So yeah, that's definitely one to watch. Thank you for your thoughts on that. So moving on, we're almost at the end now. What else can we talk about here? Well, it's been quite pleasant not to have to talk about Saba this week, but it is interesting, a couple of recent announcements which are relevant here. This week we heard that European Smaller Companies Trust, which is managed by Janus Henderson, they've agreed another 30-day truce, so to speak, so they can try and negotiate some kind of agreement with Saba. And that follows, I think last week we learnt about Montanaro UK Smaller Companies Trust. Surprisingly to some, Saba sold its stake at a significant discount, around 8.5%. The trust says that. Others have suggested a slightly narrower figure, but they may be self-interested. So how do you reckon the state of play now with Saba in the light of that news?
It's hard to say, isn't it? Because we don't really know what's going on. But I do think effectively things are on hold. And so Saba is now, of course, on plan F4G or H, it's somewhere down the line. And it's probably now thinking about how to get out of these positions without losing too much money or hopefully at a profit for itself. And that's an interesting task for the boards of these trusts because, of course, they have to balance the needs of all shareholders, not just Saba. And so that was an interesting move by the Montanaro Trust, effectively conducting a major buyback, which took out the Saba stake. And that's one way of dealing with it. But of course, you've got to be fair to other shareholders as well. So if you're offering to buy out the Saba stake, you ought to be offering to buy out the stakes of anyone else who wants to sell. So it's a fine balancing act, I think, for boards. And in the meantime, you have got trusts who are under pressure to do something and probably create some kind of exit, maybe another tender offer or some kind of way out for Saba to save face and save some money. But we don't really know what's going on in these negotiations, so we'll have to wait and see.
Yes, I've written some thoughts on that particular situation at Montanaro UK Smaller Companies Trust in the weekly email this week, because that's an interesting development. And the trust has actually recently announced that it is targeting a single-digit discount, whereas before it's traded wider than 10%. It has been defending that. And I think their argument is that they have been defending that, and the price that Saba got was no greater than they've been buying back shares from other investors. But it's an interesting development nonetheless. Well, there are plenty of other things we could have talked about this week, as always, in this podcast, and some of them you can read about in the weekly news summary that we do. So there has been news from a number of other trusts that listeners might be interested in. The German Residential Property Trust, PSDL, Phoenix Spray Deutschland, that's put out some news this week. We've also heard about an asset sale from the Renewables and Infrastructure Group, and plenty more as well. So if you want to catch up with that, then the way to do that is to find your way to our weekly email and become a subscriber to the Moneymakers Circle, where we boast now that if you don't want to miss anything that's happened, that's the place to go. If you want to go and get further analysis, then one of your ports of call should definitely be Andrew McHattie's Investment Trust newsletter, where he covers a number of these stories in some depth every month. So thank you, Andrew, for your thoughts this week. I look forward to the next one. And, well, the old curse, maybe live in interesting times, is certainly holding true this year with knobs on, if I can use that rather inelegant phrase. So that's it this week. I should mention that I shall be appearing at the Master Investor Show on March 29th, and I will be signing copies of the Investment Trusts Handbook. And I should mention also that we now do have available the audiobook of the Investment Trusts Handbook, where you can actually listen to some of the main chapters, including the one contributed by Andrew himself. So I can recommend that. So please do go and check that out. We are expanding the approach of the handbook to cover all available distribution channels and all means of communication. Thank you, Andrew, and we'll talk again soon.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.